All right, guys, I'm Big Mike, and like always, I'd like to thank you for being here today. Today we've got Top Step Trader here to talk about post-trade analysis and improvement. And John Hoagland is here. He's the Director of Scouting at Top Step, and so is Andre. He's the Director of Trader Development, and I think actually this is Andre's first time doing a webinar on BMT. Some of the topics they want to cover today include just the facts like metrics, journals, market state, plan, execution, mental, intuition, and outcome, and the review process like honesty, profit and loss, risk reward, winners and losers, etc. So a lot of details to cover today. And they've asked that as you guys have questions to go ahead and just hold them until the end of the presentation, and at the end we'll take those questions. I do want to remind everybody that the webinar is being recorded, and I'll post it on BMT sometime tomorrow. If you're watching this recording at a later date on YouTube, do me a favor and give us a thumbs up if you like it. If you're watching it on BMT at a later date, then do me a favor and fill out the feedback form right below the webinar. All right, guys, here comes John and Andre.
Okay. All right. Thank you, Mike. Thank you for once again hosting a webinar with us. It's always an honor to be part of Big Mike's Trading Forum. I'd like to thank all the attendees, first for trusting us with your time. It is truly our goal and our hope that we're going to be able to provide something for you today that you can use moving forward in your trading. There's probably many very experienced traders out there, as well as some people that are relatively new to trading, but we're hoping that something that we're going to bring to the table today is going to increase everybody's odds of success in futures trading in some way. There is a ton of information available on reviewing your trades, metrics, even services that offer to do these things for you.
And John, before we get started, are you able to go into full screen presentation on PowerPoint?
I'm sure I am. I'm sorry about that.
That's all right. Thanks.
There we go.
Perfect. Thanks, John.
Sorry about that. Thanks. There's, as I was saying, there's a ton of information on review. We don't claim to know all there is to know. I don't think anybody really does. So we're going to be talking about what we do know, and we're coming at this from the vantage point of the discretionary trader. We're going to discuss some of the things that we look at, some of the things that we use in our own trading and that we're seeing other people using with varying degrees of success. And again, it is our real hope that we are able to provide something for everybody that they can use moving forward. We're also going to be presenting you with a document that we've created, something that I've been using, Andre's been using. We've got a number of people that have been using it, and they say that it's really, I feel as though it's really been organizing my review and helping me move forward as a trader, and several other people that have been using it are really appreciating its usefulness as well. So we're going to present that to you at the end of the webinar, and you'll also be able to visit the Top Step Trader website, topsteptrader.com/contact us, and we will send you copies of it. So let me introduce myself. There we go. That's me. I'm John Hoagland, Director of Scouting at Top Step Trader. I've been in the futures industry for 30 years now, a full 30 years. I'm in my 31st year. I started out as a runner, like most people did back in those days, worked my way up, and eventually became a proprietary trader, a self-funded trader, and a floor broker for about 20 of those years. So I've got a long history in the industry. My family has a long history in the futures and cash grains industry. My father was the hedge manager for Ralston Purina for almost 40 years, and his dad before him traded cash grains out in Iowa and Nebraska. And I've been I joined Top Step Trader back in 2011. Let me introduce my Director of Trader Development, Andre McHugh. Andre?
Thank you, John. Yes, hello everyone. Thank you, Big Mike, for allowing me to do this for the very first time. Pretty excited about it, and thank you to all the attendees that are here, giving me your time and lending me your ears for this afternoon. Anyways, like it says on the screen, I'm Director of Top Step Trader Development. I started back in the industry back in 2001. Out of high school senior, became a clerk on the floor, working in the soybeans pit. It was fascinating and exciting all at once, even though I had no idea what was really going on at the time. After school, I got out, became an independent trader in 2006. Since then, I've been trading locally for myself, and then in 2011, as it says, I joined Top Step Trader as Director of Trader Development. Ever since '06, I've been working on my self-improvement, my post-trade analysis, constantly looking to better myself. When I heard this opportunity for this webinar on this precise topic, I jumped at the chance as I have seen real results and really seen things take off, not only with myself, other traders we work with at Top Step Trader, and colleagues and mentors alike. So without further ado, we should let's get into it, talk about how we can better ourselves. So why is the importance of reviewing your trades? It's a vital gauge of your development as a trader and your trading plan evolution, as it says. As far as your development as a trader, we need to look at the strong points of our trading and the weak points of our trading. Those strong points being within our review. We're looking to take advantage of what we do well as a trader, what our strengths are, and what those strengths may be. We need to remain as strengths as traders and look to build upon those. Essentially, that's where our profits come from as traders, and without those, things can get very tough, very difficult very quickly. So it's important to know that. And also, reviewing will help maintain and develop your strong points as a trader. So essentially, like I said, you make those strong points, you keep those strong points, and you don't let those slip. Also, this allows us to continue to develop as a trader, and we're trying to maintain reasonable expectations within our review to track our progress, not get too down on ourselves when things may hit a rough patch, as they inevitably will for all traders. Essentially, this is why we review. This is why we try to improve. And we are our own coach, so therefore we must remain so. John?
Thank you. When you take a look at your weak points as a trader, these are obviously points that you need to know. If you are lacking in certain areas, let's say risk reward, something you definitely need to know. When you are reviewing your metrics, your trading metrics, as well as your mental metrics, you've got to be honest with yourself, because there's definitely going to be a difference between what we know and what we think we know. When you are having a difficult time with a particular trade, market situation, it may just be that we have found something that we need to work on. We have found a weak point. This has to be noted, looked at, and reviewed. Your weak points are going to point out what you don't know, what you need to know about your trading plan, and perhaps a lot about yourself. When you find these weak points, it's very easy to become down, to get down on yourself. I encourage you, don't allow yourself that luxury. If you sit back and think, maybe I just can't do this, or I'm not good enough, smart enough, it does nothing for you. You've found a hole in what you know. It's time to go and do the work to find it and fix it. And your review is going to lead you down that path. Not saying that it's easy or quick, but it's really the only way you're going to be able to point these things out, find them, and fix them. I have to wonder, I don't know how many people actually review. I'm coming from the trading pit. I know we walked into the pit with a minute to go, and we left them with a minute after the bell. And I always went through with my trades and thought about the things that I did. And but I know most people threw their dupes up in the air or stuck them in their clerk's pocket and went on to do whatever they were going to do for the rest of the day. And I know most of them had no trading plan. If you are going to be a screen trader, it is crucial that you have a trading plan. Your trading plan is going to evolve. It is a work in progress. I think it's important when you are putting together a trading plan just to start simple. You've got to find things that fit your trader personality as far as the products you're going to trade, the volatility that you prefer, the time frames that you're going to be in trades, even the time frames of the tools that you're going to be using. And it's at that point where you begin to start trading your plan. You're making small adjustments. And if those small adjustments are consistently applied, you will see eventually what kind of results those adjustments are making in your trading plan. Your trading plan will also increase your self-knowledge as well as your market knowledge, because your plan needs to grow and it is going to change over time. There are so many details and so many different scenarios in trading. If you don't have a plan and you're not reviewing, it's almost impossible to try and remember all these things. So your trading plan is going to be necessary for you to even have information to review. You're going to want to review daily, weekly, and monthly how your trading plan is doing, which leads us to journaling.
Journaling. Why is it important? Why is it necessary? Well, this is one of the first steps of your self-review, of analyzing yourself and your trading. So first, your journaling begins with the trade facts, or the trade log. What is in the trade log? Well, this is all the facts of your actual trade. Did you go long? Did you go short? Did you buy? Did you sell? How many? What was your quantity? What product did you actually enter? What market were you in? What time of day was it? What was your profit targets, your prices, your entries and exits? All these things, the actual facts of the trade. Yes, they can be found in the audit trail, your fill window of your platform. John and I and other traders alike, we've kind of found it a little bit more self-fulfilling if you physically write down the facts of your trade, not the second after you get in the market and you get filled on your order on your ladder, your dome. But after you have entered the market quickly, we jot down in our journal, the prices we got in at, the time we got in at, where we placed our stop, where we're looking to get out, and anything else that we may come to mind. This all goes into your journal and in the trade log, which will contain your trade facts, as it says here on the slide. Again, this journaling, it's a daily, it's a weekly, it's a monthly activity. I can't stress that enough. It requires an active participation by the trader and a commitment to the practice. This is something that it's a commitment, like I said, and it needs to remain so in order to get the full benefits of review after the facts. We're simply recording data at this point. When we're looking at our profit targets, we record this, and upon our review, we can see if we've strategically placed these stop prices and profit targets within reasonable areas due to the proper market state. If it's a trending market, or if it's a range-bound market, or if it's a breakout market, your stop prices and profit targets should be placed accordingly. Now, when jotting this down in your trade log, and then upon review, you can go back and you can see, hey, maybe was I trying to swing for the fences a little too much, or was I being a little bit too risk adverse? This is something that you look back after the fact and you use looking forward for your next trade. But most importantly, you're constantly journaling and you're trading. You're writing down all the important facts of your trade. This is the data that's being deemed essential to the review process. So this is stuff that we're constantly. I can't stress it enough. It's a constant update to your journal and a constant update to your trade log. When you're jotting down the product, different products trade differently. They have different volatility. Some can be as volatile as crude oil, for example, whereas some can be as least volatile, like the 2-year. It's important to write down the product, different personalities, different volume profiles, and such. And based on the product, are these products, are they fitting your trader personality for yourself? It's important that the market you trade and your personal trade style, mechanics, they jive and they sync and they align correctly. But this is all done in the review. Maybe my personal style isn't really syncing with crude, whereas maybe it would be syncing better with the euro, for instance. We're writing down the day of the week. Believe it or not, some traders that I've spoken to and dealt with, and I'm sure John can attest to this, different days of the week, maybe a Monday and a Friday, are slower than Tuesday, Wednesdays, and Thursdays. Certainly Mondays and certainly Friday afternoons, a lot less volume, a lot less volatility, whereas Tuesday, Wednesday, and Thursday, everyone's back at work, everyone's back on the floor, everyone's trading, and the news is being digested and acted upon. So it's important that we record what day of the week we're trading, when the trade was made. Of course, the time of the day, whether it's the morning, the open, there's a lot of flurry of activity, a lot of open orders coming in. that could affect the market, have wild swings in price action, so on and so forth. Whereas we get to midday around lunchtime, the market seems to find a lull throughout the day, and things tend to slow down. You get stuck in a range, but it can't be confirmed until we're writing that down in our trade log, and we're writing down these facts that, hey, maybe my stops were a little bit too wide, my profits were a little bit too ambitious during the lunchtime trade. It was stuck in a 3 or 4 tick range, and I'm hoping for a 10, 15 tick move. Upon your review, you can say, hey, next time I get into this trade, tighten up the profit targets and just, hit, for a baseball analogy, just hit little singles, build up a nice little profit going into the afternoon or the close. Where about, I don't know if you guys watch CNBC, but she always said, as Maria always says, it's the most important hour of trading going into the close. And there's a reason for that. She is honest to something, whereas you see a lot of market orders come in, the MOCs come in, and the flurry of activity does tend to pick up. So when you're writing down your trades, very important to keep track of what time the trades are going in, what you're noticing as far as market activity goes, and from there, you'll get a better idea based on entering your trades of your MAE and MFE, which is something of John's specialty that he'll certainly touch on.
Well, I don't know if it's a specialty of mine, and it's something that's new that I've been looking at and using in my own trading, as well as looking at how other people are doing in their trading. And really, we're going to take a deeper look at that as we go through each metric in a few minutes here. One of the other things that we think is important to look for is you need to track your stop outs and profit target hits. How often are you hit for a full stop out? How often are your trades reaching the expected profit target? Something important to track. You should also be tracking price action after liquidation. I'm not an extremely active trader, so I usually have a few minutes to watch what goes on after my trade is liquidated, whether it's a full stop out, a managed stop out, or a profit target hit. Sometimes you may find that the setups that you're looking at could be worth more. Sometimes they remind you to have reasonable expectations, and you are always considering your strategic stop placements. So along with your journaling, you're going to have that real-time trade diary. In your diary, you should really be keeping track of market state identification. Now, this is a very subjective subject, but it's crucial to always be trying to identify market state for a number of reasons. Probably the most important one to me is for finding good trade locations and targets. You want to mark down what tools led you to your hypothesis of market state. Was it candle patterns? Was it profile? Was it the daily chart? Keep track of what you are identifying market state with, and you can then figure out how accurate you are in your assessment of the market state, what time frames you're using to establish the market state, and if news is involved. News, as we all know, can change the market state in a heartbeat, and that's something that you're going to want to be marking down in your real-time trade diary. If there's an event or a report that changes market state quickly, it's very important that you keep track of that and try and make that part of your intuition for the next time you see that situation. Another thing that's important to have in your real-time trade diary is your mental state. This could actually be one of the most important reasons that people succeed or fail. Your mental state is going to affect all of your decision making. If you can control your emotions, which I don't think most people can, then that's great. Even better than controlling your emotions, which are probably telling you it might be time to act, learn what they're telling you and learn how to stop trouble before it starts. I'm fully aware when I begin to feel emotional when I'm trading, my decision making is out the window. I find it extremely difficult to make decisions that are in my best interest, and if I begin to get emotional, I know it's time to walk away, at least for a little while, until I can get my emotions under control or release them. Things that I track in my trading, and these are all part of the document that we're going to present to you near the end of the webinar here that you can track. Your humility. I always try and keep humility on my lips because having humility keeps your ego out of what you're doing, helps you accept market information and responsibility for the decisions that you're making. Nothing that happens in trading is the market's fault. The market does not do anything to anybody. It's what we do to ourselves. When you do get emotional, it's not about controlling necessarily the emotions, but you have to be able to control the behavior. Another thing I like to track is my anxiety level before, during, and after a trade. There's the evil three that I like to keep an eye on to see if I feel them rearing their ugly heads. That's ego, fear, and greed. If I am angry or elated, I find my decision-making compromised. I rate myself on these pretty much per trade. Esteem. If you don't believe that you deserve to succeed, you will not. Even if you have a period of success, you will find a way to give it back. 20 years ago, I worked with a trading psychologist who brought this to light to me, and it made a big difference in my trading. So it's something that I keep track of. If I am not feeling confident and deserving of profits, I will certainly find a way to give them back if I even have the opportunity to make them. Track your stubbornness. If you're unwilling to accept the market information as it's coming to you, I know a number of people that have issues with this.
John, are you saying I'm not always right with the trades I'm making? I can't believe that to be true.
Well, we all tend to get a little stubborn from time to time.
Just a little bit, just a little bit.
Rate your intuition per trade, per day. You're going to find that your intuition is going to be better on certain days. Matter of fact, some people shouldn't trade certain days, and keeping track of this and reviewing this can help you figure out which days those were. You know, my dad is a trader, and he used to tell me, son, I could increase my income. I could double my income by only trading 3 days. And I said, well, Dad, why don't you just trade 3 days during the week? And he'd say, okay, well, you got to tell me which 2 to take off because I don't know which ones are going to be the bad days. Well, maybe he should have journaled. Maybe he should have reviewed. Quite often, as a matter of fact, I believe in everybody, there's a need for approval. We all want to be a part of this big family, and that's going to affect your decision making. And then again, rate yourself on flexibility. You have to be able to continually accept market information, and you have to understand the difference between accepting market information and manufacturing intuition. Sometimes we think we see something that turns out not to be the case. So you continually objectively accepting market information is going to be key. I rate myself on these, and I'm going to show you how in a little bit. I also like to keep track of the ease of execution of trades. Some trades are going to be harder to put on. They're part of your plan, but you're looking at the chart thinking, oh my God, you know, this is part of my plan, this is my signal, but boy, this really does not look good. I found that those can tend to be some of the better trades. The easy ones tend to be some of the worst. Quoting Jim Dalton in his books, he says the best trades tend to fly in the face of recent market activity, and they're hard to put on. I become suspicious of trades that are really easy to take. And one of the most important things as far as your real-time trade diary, I think, is your compliance. That word tends to make some people nervous, but I'm talking about your compliance to your plan. How close to your plan did you stick during the trade day, during the week, during the month? Rate yourself on this. It's very important that you understand that if you are deviating from your plan, your results that you're reviewing are getting skewed. If you have a high level of compliance, you're getting the best information from your review, and it's going to help point out behavioral patterns that you can use in your trading. So we've taken a look at the trade log and a look at journaling a little bit here. We're going to get a little deeper into the metrics now, and Andre is going to take over here.
So basically these metrics that we're about to touch on here coming up allows you to ask yourself and identify, what am I doing well? What am I doing well as a trader within the day, within the week, within the month? As the market state changes, what am I doing well? You know, what am I doing poorly? This is probably what we're going to focus on more than anything. As much as we like to, sometimes pat ourselves on the back, we can only get better by really turning weaknesses into strengths or not making them as big of weaknesses as they usually are. And then, based on how well I'm doing and how poorly I'm doing and what I am doing poorly, how is my progress? How am I attacking this? What am I doing to get better? John's throwing me uppercuts right now because we're trying to get better every day, and we're working on our left-right combo. No, I'm kidding. But what we're doing is how we doing, how's our progress? And based on my progress, based on the state of my trading, most importantly, traders should always ask, should I add or decrease risk? Could that be from trade to trade, from hour to hour, from session to session? It all depends. It depends on how those first three questions are adding up, and that can answer your fourth question very easily. So like we said, these metrics that we're going to touch on, we have touched on. These are some, not all metrics out there. There's probably not enough time in the day to go over every single metric out there. Some we don't find as relevant to a day discretionary trader like ourselves. These are the metrics that we're going to be touching on, and the ones that we found useful that have really, put the spotlight on areas that need most attention, most focus, in order for us to extract more profit out of the market necessarily, or sometimes just controlling our downside, which a lot of traders will say, the winners take care of themselves. It's the downside control that really needs the most work. And personally, I tend to agree with that. If I control my downside, my upside takes care of itself. It really is cliche, but it's true, as much as I don't like cliches. And of course, we're trying to explore, to find and develop new metrics out there, especially over the last couple of months, and I guess 6 months, we've come up with a couple new metrics that we're still working on, fine-tuning on, but it kind of allows us to grow and gets us better as a trader. So, touching on what are you doing well or what are we doing poorly? This is essentially you, the trader, myself, the trader, John. We are looking in the mirror and we're having an honest heart-to-heart with ourselves. We're not patting ourselves on the back too much. You need to be honest. Am I holding on to winners well? Maybe. Maybe I might be holding on to losers too long. I might be getting a little bit too stubborn in your trades. I think we've all suffered from that, some more than others. You never know.
Not you, Andre.
No, never. No one, never. Upon reviewing your real-time trade diaries, areas of improvement and signs of strength will come to the forefront and grab your attention. You got to note these down, and you need to focus on them. The more you focus on them and pay attention on them, you might catch yourself actually realizing some of these areas of focus coming up while you're actually in the trade. And when this happens over time, it'll happen. This is when you kind of feel a little bit of enlightenment into your trades. It makes you notice, and your senses kind of tune in things that you might otherwise not have been noticing. Using these metrics, like I said, will alert you to the areas of improvement. And again, objectivity and honesty is key when having that heart-to-heart with yourself and looking in that mirror. I can't stress that enough, and we're gonna beat it like a drum until it's broken, because you need to be honest with yourself, and objectivity is very, very important for self-improvement. Now, touching on how is my progress? How am I progressing? How is my trader plan progressing? Is it staying current with the market state? Is it staying current with the type of trade we're in? It's after identifying your areas of strength and weakness. Now we can start tracking progress. We can start making sure that our strengths remain so, and that our weaknesses don't get worse, per se. And we try to, I guess, stabilize them at the very least, and eventually turn those weaknesses into strengths, whether those weaknesses be mental or whether they be technical as far as entry points and exit points, or is it, I put on 2 losers in a row, I kind of lost my head, and I lost my whereabouts, and now I catch myself going on tilt a little bit, and I'm trying to chase losers, and we all know how that story ends, and it's never pretty. So basically, it's how we're tracking our progress with respect to what we've done well and what we've done poorly. It gives you a baseline, and it kind of gives you a progress tracker from there. And how is my progress and evolution of my trading plan taking place? In your trading plan, you've got market state identification. John and I find that very key and very important to our evolution as a trader. So as market state changes, or say we see a new market state we haven't seen, we see a big range-bound trade, and that's on a Monday, whereas on Tuesday, we see a nice trending market, and we need to make sure our trading plan is taking into account for all those market states and is evolving correctly. And that's going to take constant review, constant referencing back to the trading plan, and making sure that indeed it is current and it hasn't gone stale. But like I said again, it's a breathing document, and we're constantly working on that and tweaking it. And by the time you've gone over it 6, 7, 8, 9, 10 times for months on end, you'll have it kind of memorized, and you'll get a little bit annoyed, but nonetheless, it is something. It's like your Bible, and it's something that you need to constantly harp back on. Now, with those previous questions being answered, the most important question you should ask yourself is, should I add or decrease risk? Well, one of the goals of reviewing and evaluating is to know whether to do such. Sometimes we need to step on the brakes, and other times we need to step on the gas. When do we step on the gas? Well, if I'm seeing the market well, And if I'm trading, trending markets well, and I know that I do this well, and I know that the range-bound markets are what I trade poorly, but I'm not seeing it. So according to my trade plan, I know that in trending markets, I'm going to widen the stops. I'm going to increase my trade duration, as we'll touch on here in a little bit. Now I know I can increase my risk because I've read the market properly. I've gone back to my trading plan, and my trading plan has laid out the execution strategy. And sure enough, I've been able to step on the gas a little bit more, take on a little bit more risk, put on a little bigger size trade, widen the stops, and increase the profit target for a higher profit margin. And this is all done by proper execution because you answered your previous questions appropriately. And also, is your mental capital where it needs to be in order to add risk or decrease risk? If you're mentally in tune with the market, you don't have other distractions going on in your outside life, this could also allow you to step on the gas a little bit more. Whereas if you have, your kids screaming in the other room, and maybe they just broke a dish in the other room, now your mental capital is 100% there. Maybe you want to look to tighten up those stops or dumb down the size a little bit, because that's how you can turn a bad day into a disastrous day. So these are some of the things we're going to be touching on looking forward. And with that, we'll go to the actual metrics.
Let's take a look at some of the metrics themselves and how we view them, how we can use them in our review to let us know how things are going. One of the first ones is the average number of trades or your trade frequency. I get this question a lot. Am I over trading? To which I usually answer, I don't know. Are you tracking? How are the trades working out? Have you tried trading less? Have you taken a look at your trading plan to decide, if you're trading in too short a time frame for yourself? Short time frame traders tend to, of course, trade a little bit more. Longer time frame traders be trading less. The second thing I usually say to this is, if you think you are over trading, you probably are. I think people new to trading tend to be the ones that are most guilty of over trading. Over trading, maybe you're over aggressive. You can be chasing losses when things aren't going well, and all of a sudden you find yourself doubling the number of trades you would normally take in a given day or a given part of a day. You could be trading emotionally, and you're probably not following your plan if you feel as though you may be over trading. If you are trading a plan, you're not going to be able to overtrade. You're only going to be taking the trades that are in that plan. If you feel as though you may be under trading, you've got to ask yourself, do I even have a plan? Am I trading in fear? One of the most important things to being able to take the trades that you deem have a good possibility of succeeding is that you have a plan. You know, if the trade goes your way, what you're going to do in managing that trade and where your profit target is going to be. You also understand and know that you're going to have a stop loss at a point of failure for the trade strategically placed, and you are going to leave that there. If the trade proves to you that it is not a good trade, moving that stop further away just usually creates larger losses, and in some cases catastrophic losses.
That's a no-no.
So if you are questioning how often you are trading, you need to really take a look at your trader personality and figure out who you are as a trader. If you need to be involved and you need to be constantly engaged, maybe even entertained by the market, you're probably going to have a shorter time frame, and you probably lean more towards the scalping side, which you're going to be wrestling with a lot of HFTs to get those scalps. If you are finding that you are a longer time frame trader and you may be changing over time, that's what this review is for, is to find out who you are on a continual basis as a trader. When you're looking at the average number of trades or the trade frequency, you've got to take a look at what the market condition warrants, because different market states are going to warrant different levels of participation. Ranging markets are probably going to offer more opportunities to take trades, but they're going to be for less profit. Your ranging market, you may have a market that's ranging from near its high to near its low. It may rotate back and forth several times during the day, which gives you several opportunities to take trades. But they may not be worth as much as being in a strong trending market. You may only get a couple of opportunities to get in at good trade location in a trend on a daily basis. But it's probably going to be a larger profit, and that's going to be something you're going to have to take into account in your trading plan as well. If you are in a trend, you may decide you will not have a profit target. You may have a stop management plan for trending markets. Your average winning trades and your average losing trade. This is one of the most important metrics in the world, at least to me, and I think it should be to everybody. Your trading plan's goal, it should be to keep the math on your side. If you can count on being right about half the time, and I think most of us are probably going to end up there over time, you've got to make more on your winning trades than you risk in your losing trades. This is your risk-reward ratio. Nothing can ensure success, but a bad risk-reward ratio can certainly ensure failure. There are a lot of people who like to lean on high win ratios, on the high win percentages. I was 80% right last month, but did you make any money? Well, no, I ended up losing money. Well, then obviously your risk-reward is skewed. One of the other things that your average winning trade and your average losing trade are going to tell you is if your stops and profit targets are reasonable for the market states that you're trading. One of the ways that you can check out your risk-reward ratio and your plan over time is if you have some records, you can check out your profit factor. The profit factor is your win percentage times your average win divided by your loss rate times your average loss. Any profit factor less than 1 is going to be a losing plan. It's just mathematically that way. So if we take a look at a winning plan, if we're right half the time and our winners are worth $10, 50% of $10 is 5. Divide that by what our average loss is. We're wrong 50% of the time. Our average loss is $5. 50% of $5 is $2.50. $5 divided by $2.50 is $2. This is your profit factor. This represents a 2-to-1 risk-reward ratio. You could be right 70% of the time and still lose money, because if you're right 70% of the time, but you're only making $2 on your winning trades, 70% of $2 is $1.40. If you're wrong 30% of the time, but you're risking $10 on every one of those trades, you can see how the math doesn't add up. 30% of $10 is $3. $1.40 divided by 3 is 46 cents. This is a churn and burn plan. It will never make money if the risk reward stays this way. So you could take the metrics that you have, you can plug them into this simple equation, find out what your profit factor is. If it's less than 1, it's time to go back to work and work on either being right more often, which that's going to vary from time to time. I think a high win rate is very difficult to sustain. Count on being right about half the time and make your winners worth twice what your losses are. You'll at least cover costs. And you may even begin to build the account. Continue building the account and add volume to this winning plan. And you may be onto something and ready to build your way to success. Andre?
Yep. Well, on top of having a profit factor greater than 1, which is extremely essential for longevity, profitability in this market, hell, trying to get rich one day, let's be honest, we need to look at trade duration of each and every trade that you're in. This is something that we track, and we'll make it nice and easy and pretty for you here at the end of this webinar and this presentation, so it'll be easy for you to track that. Essentially, the time value to each trade will allow you to ask yourself and help evaluate yourself. Are you holding your losses too long? Are your trades market state sensitive? And are you holding your winners long enough? Are you letting the winners ride? Which is, like I say earlier, is cliche, but it is very true. So the duration of your trade, like we said earlier, it has to change and be market state sensitive. There's a time value to each trade. You know, once you enter a trade, the time may eventually begin to work against you. What I mean by that is there are many factors that go into making a trade. You have your indicators, you have your intuition, you have your technicals, so on and so forth. So now I enter the market, and the longer I'm in that market, and the more outright I'm in, that market. Now I'm exposed to unforeseen variables that I did not take into account at the time of market entry. So the longer I'm in that market, the more likelihood of a chance that something happens where I may get blindsided by a move. This is by a move that I didn't see coming, I didn't take into account. So you have to ask yourself, are my trades, am I into the market for too long, according to my risk-reward ratios? Now also, am I holding on to my losses too long? Very important thing. Like you said, if you control the downside, the winners will take care of themselves. Why am I holding my losses too long? Am I being stubborn?
Not you.
No, stop. maybe every now and then I could be a little stubborn. Sometimes, what didn't I see, or what didn't I realize when the trade was going against me? This is stuff that we're all, journaling down, jotting down, and this will help you reassess upon your review after the day's over or after the week is over. Of course, this is all market state sensitive. Trending markets, like John said, may need longer durations, whereas range-bound markets need a shorter duration. So while you're doing your journaling, you're looking at, I got in, 10 o'clock 000, then I got in, I got out, 10:15. It was a range-bound market, so my duration was nice and short, so I had proper market state identification. I had good time duration. Whether it's a win, loss, or scratch, I still followed my trading plan, and my execution was good. Once we get in the market's going to do what it's going to do. But most importantly is I didn't hold on to my trade. I wasn't in the market too long. The trade didn't get stale because I identified it as a range-bound market, and therefore I traded it correctly. And whether it's a win, loss, or scratch, I'm happy with whatever the outcome may be. Granted, we want it to be a winner, of course, but not every trade is going to be a winner. All we can control is what we do going into that trade. Now, another thing that I'd like to talk about quickly as far as duration is something you might not hear a lot about, but we at Top Step Trader harp on it quite a bit, and that's opportunity costs. What do I mean by opportunity costs? Well, the longer you're in a trade and the market isn't going anywhere, and you're in this trade, or you keep taking constant heat on this trade, and it becomes a bigger loser, and sure enough, you catch yourself sliding that stop further and further away as the market gets closer and closer to your stop. So basically, you're running away from a loser. Or the market's just in a 1 or 2 tick range, and you're just sitting in that trade, and you're outright. And, there's opportunity elsewhere you might not be looking at. You might be focused and honed in on that one dumb trade that you're married to, and the more you get married to a trade, the more likely it is going to be a loser. Whereas you could look, say you're in the S&Ps, and you're sitting there, and the market's just chopping around, and you're expecting a breakout to the upside or downside, whatever it may be. It just hasn't come yet. Whether it be lunchtime or even in the morning, and it's just a slow trade, And then you're also a Euro currency trader, and sure enough, you see after the fact, upon your review, you see that market was moving well. There was good volume in there. There was good volatility in there, and it was making sense to you. Upon review and upon analyzing charts after the trade, well, that opportunity cost just cost you a great chance to make some money, whereas you could have taken your loser in the S&Ps, or you could have gotten out for a scratch or maybe a small winner, but you were married to that trade so long, and you were in the zone so long with that trade, that you missed out on great opportunity elsewhere. So I talk about this trade duration, and it's important to know what is going on in other markets around you, not just the market that you're currently in. So it's something that you need to think on, and we'll be able to, like I said, we'll make it nice and easy for you to record later on when we give you that little template we put together for you. But with that being said, I'm going to go on to MFE and MAE.
Maximum favorable excursion, maximum adverse excursion. How far does the trade go against you? How far does the trade go your way before liquidation? This is something new that I've been looking at. I know many people have been using this for quite a long time, but I'm finding it a great tool for validation of my trade initiation location. If my trade location isn't that good, I may tend to have to have wider stops. So I'm really a stickler for trade location, and anything that helps me with trade location is something I'm definitely going to be using. So it will give you some validation of your stop and your profit target, and I think it's important with maximum favorable excursion and maximum adverse excursion to continue to accept market information while in the trade, of course, but also to track track price action after liquidation. This can certainly be a helpful thing in deciding whether your expectations are reasonable or if you could expect more out of your setups, out of your trades. So I've been tracking tracking MFE and MAE on a trade-by-trade basis, but also on a P&L basis for the day. And I do a weekly review now, and I do a monthly review where I take all this information that I have been tracking, and I look at my performance at the end of the week and at the end of the month. And when I have good results in the metrics and the mental metrics, I can certainly see it in my bottom line. So it's a very important thing to be tracking. So we're going to show you shortly here. We're going to get to these forms that we've put together and we've been using, and I think you'll find them useful. But now Andre's going to talk a little bit about consecutive wins and losses.
The consecutives, yes. This is where we talked about, should I add risk or decrease risk? Well, this is another way to let you know, am I going to step on it or am I going to, rein in the horse, so to speak? You got your consecutive winners and your consecutive losers. As far as your consecutive winners go, was my plan and intuition in step with the market? If so, am I sizing up accordingly, right? Or if I'm having a rough patch and I'm going cold and the losses start adding up 2, 3, 4 in a row, obviously it's pretty much the worst feeling you can have, and you could get down on yourself. Is your mindset wrong? Or am I just not reading the market right? So let's talk about your plan and intuition in step. We talk about identifying market state consistently. Doesn't mean every second we're asking myself, all right, are we range bound, or are we trending, are we in a volatile, choppy, thin, liquid market? But we are trying to get a read on that day or that hour or that morning, afternoon, or lunchtime midday trade. With that being said, you've got your plan, and is my plan in step with what the market state may be? And is this leading me to have a couple consecutive winners? Am I getting hot? Say I put 3, 4 trades on in a row that happen to be winners. Well, it's pretty likely that yes, your plan is working well, your intuition, your thought process is going into the trade quite well. And with that being said, it's probably time to maybe bump the size up a little bit, maybe double the size, and also widen the stops and expand those profit targets. When things are going well, it's time to really capture those opportunities and capture those profits. It's like John said, his father, made money 3 days out of the week, and the other 2, not so great. But on those days that you know that you're hot and things are working and your plan is working properly, you got to step on it. You got to push it. This is why we're all traders. This is the best part of trading, in my opinion. And this is doing self-review in the moment, essentially. It's a little bit more maybe of an advanced skill or something that you need to be more in tune with yourself, possibly. But it's time that you size up and you wind the gaps and you wind the stops when you are hot. I guess that might be a little bit easier to do. It's the consecutive losers, which is, I guess, the lame part of trading, and the part of trading that we might not, isn't the most glamorous part, and they never really talk about in the movies for some odd reason. When we're talking markets and we're talking trading, it's odd how that happens. Anyways, you could ask yourself, when you have 2, 3, 4 losers in a row, am I reading this market correctly? Oh, my charts are saying, we're in a range-bound market. We're, in fact, for instance, today in the ES, it kind of felt like a range-bound market, but we just constantly grinded higher and higher today. It was slow, it was monotonous, and it wasn't very pretty, to be honest with you. But it wasn't necessarily a range market. It was a recovering market that in the afternoon we were just constantly grinding higher and higher. So it was a trending market where the durations are going to be longer, and maybe you were trying to play the range today and you had 2, 3 misreads of the market. And when this does happen, you ask yourself, maybe my mindset isn't there. Maybe I'm chasing losers from the morning, and I'm trying to catch them all back this afternoon. So I put on three losers in the morning, went out, left the market, went to go have lunch, thought about my losers, harped on them, which we've all been there. What could I have done differently? What didn't I see? And then you come back in the afternoon. You need to really check with yourself after those consecutive losers that, okay, I've got a clear head. I'm going into the market with a fresh new perspective, and you're able to do such. Now you put on another couple losers, then it's time to ask yourself, is it time to pull the plug on myself? Sometimes you might want to dumb down the size and tighten up the stops because you aren't reading the market well, and that's made apparent by these stop outs and the losing trades. It can get to a point where it is time to stop and call it a day. That's okay. It happens. I've been there. Last week I had to pull the plug on myself last Wednesday. It was a very volatile trade with the Cypress all the news coming over from Europe regarding Cyprus, the bailout. I was wrong. I was wrong in the mornings, came back in the afternoon, and it just wasn't clicking. So what did I do? Pulled the plug on myself, licked my wounds at night, came in for another day, and sure enough, I was able to cut that losing day in half. So I consider it a minor victory. Essentially, it's the old adage, and something that's really important to have is you got to live to fight or live to trade another day. Without that, you're not going to have a career. You're certainly not going to be profitable. But at the end of the day, understand when you're hot, understand when you're cold, and add and decrease risk appropriately.
All right, Andre, I'm glad to hear you didn't get stubborn that day.
A little bit. That's why I had to pull the plug on myself. There's a common theme here, people.
Okay, there are many available metrics. Not all of them are going to be useful, particularly when you're dealing with leveraged products. Some seem to be more about long-term investing than again the leveraged products. There's so many time frames that you can look at your metrics, and you've got to try and focus in on your personal trading style and find the metrics that are telling you the important information. Consistent trading within your plan and consistent review will make the best use of the metrics, both trading metrics and mental metrics. I think it's important not to obsess over the metrics. Obsess over making sure that you have good data, that you have consistent data that is going into creating your metrics. And the metrics are somewhat subjective. I mean, they're going to change over time, changes in your plan, market states, and markets. These are some of the metrics that we use and that we have found to be most helpful. They've just kind of revealed over time. Record the info and details. Recording the information and the details will help you begin to form kind of a holistic picture of your trading and your progress. I'm not even sure that there's a right or wrong way to look at the metrics for discretionary traders. It is, again, a highly personal thing that takes time to get used to. It takes time to develop the strategy of review that you want to use, and it takes time to put together a plan that you can trade consistently enough to get accurate review.
So with these metrics, it's very, very important that the sample size is there. As it says, time is needed, a lot of data. We need to get a lot of data in order to get a better picture of your trading for accurate review and to point out your strong points and weak points. Any statistician out there is going to tell you you need a sufficient sample size. What's a sufficient sample size for you or I as a trader? I'd give it, say, at least a month of worth of good, solid, honest data to review. Maybe you can start picking up some tendencies. Shoot, I've got 6 years worth of data, but the data from 4 years ago is certainly not relevant to today's trade. Obviously, the data it works from market state to market state, from time frame to time frame, depending on what the catalyst of the trade may be. With that being said, it's a diligent process. It's something that you have to commit to and commit to the process. It may be monotonous at times, but I promise you it will pay off in the end.
So, even with review, much like trading, there are a few absolutes. When reviewing your trade and mental metrics, if you are not compliant to your plan, you're going to have inconsistent info for review. If you are not disciplined in your execution and honest in your review, you are cheating yourself of self-improvement when it comes down to it. We are our own mentors, and we have to realize that. So you may end up like the guy in the picture there. So if you are not compliant to your plan, discipline and execution, honest in your review, the likelihood of your metrics being skewed is great, and they will not help you. That will hinder your improvement. So let's take a look at the review sheets that we've put together. I call this first one a trade ticket. It's fashioned after the actual orders that they use on the trading floor. We've got the buy side, we've got the sell side. We got the time of the trade, the date, and the day. I have the day there because I believe the day is important. Certain people seem to trade better on certain days. Markets trade better on certain days, and this is something that I'm tracking. So on the buy side, I have a quantity, the product, the month, the price. I'm usually a one product kind of guy, so I may just put quantity and price in there. I know I'm going to be trading June. Below here on the left, we have some of the metrics that we're looking at. Well, some maybe new metrics, but these are things that I'm looking at and that a number of people are, and finding that it definitely helps. This signal. Where did this signal generate from for this trade? Was it a market profile trade? Was it a candlestick pattern? You can make a hieroglyph. You can write it out, whatever you want to do. What's your assessment of market state? Write it down. Make sure that you use the part of your plan for that market state. What's your mindset? I give myself a 1 to 5 rating on my mindset, on my intuition. I track the MFE and the MAE right here. If the trade goes 8 ticks against me before it goes my way, I'll put down 8. If it goes 20 ticks my way before I get out, I'll put that. What my original profit target was, what was my original stop out, and I may even put a managed stop out in there. On the right-hand side, I rate myself in all of these categories while the trade is going on. How I'm keeping humility in my mind, how much anxiety am I feeling, and there may be 3 numbers in here: before, during, and after. Am I keeping my ego, fear, and greed in check? I may just put a check mark there just to remind myself I've got to keep those in check. I may rate myself as to how much that is affecting my decision-making process in my mind for the trade. Am I angry? Am I elated? Am I stubborn? How flexible am I? How is my esteem at the time? Ease of execution and honesty. I give myself number ratings in all of these. Okay, and now I've got notes that I can put down here for the trade. There's space for notes here. Treat this however you want. Create your own. Use this, whatever you want to do. Liquidation, win, loss, scratch. Time, price, compliance rating. How well did I stick to my plan? 1, 2, 3, 4, 5. Did you veer a little bit from the plan? Rate yourself. And if you're carrying a position from this order ticket to the next, I like to put it there, and then I put this on my stack, and I know that I came into the next order ticket already long too. The sell side, same thing. Liquidation, position. These are, again, things that you can rate yourself. Give yourself a 1 through 5 for all of these. Put all this down. Make sure you have the day-to-day liquidations, positions. Write your notes on this. Now we have a reconciliation. This is going to be a full sheet. There's lots more room for compliance or comments. But we have all the same fields. We also have this. This is an end-of-day reconciliation. You can also use it for an end-of-week or end-of-month. The number of trades, number of long trades, number of short trades, wins, losses for each category. Again, the signals, some of the metrics, stop-outs, profit target hits. You're going to average your ratings for each trade and put them in here. I reconcile this at the end of the day. I reconcile it at the end of the week, and now I'm reconciling it at the end of each month. I take this and I track my performance P&L wise and my compliance to my trading plan. Any comments that I want to make. So that I'm gathering lots of information. I'm gathering lots of data about myself, about my trading plan and changes that I may need to look at making for my trading plan, as well as how I'm doing mentally. If you visit topsteptrader.com/contact us, let us know that you would like loadable copies of this. We will make sure and get those sent out to you. I'm finding this to be a very useful tool. Andre?
It's the best. That's all I can say. It's we've made it nice and pretty for you. A lot of all the categories and everything we've talked about here. If you want a little bit more detail into them, go back to the presentation. We've talked on every single one of these topics, every single category we've talked about. Go back to the presentation, gain a little bit more understanding about what you need to maybe track on yourself. And with that being said,
we would like to offer all the attendees that are with us today the opportunity to get 20% off any one combine for joining us today. You get a number there for some information. You can also email recruiting@TopStepTrader if you have questions. And I'm going to go ahead and I'll wrap up first, and Andre, you can finish up.
Sounds good, John.
Okay. Really what we're doing here is we're asking ourselves, did we follow our plan? Although it is constantly suggested in the trading community, most traders do not employ the due diligence needed to enjoy the benefits of your review, of the review that you do. This is the Holy Grail. It is the Holy Grail is doing the work. If you cannot find a way to honestly evaluate your performance, you are lengthening your learning curve at a great disservice to yourself. Some of these metrics may prove important to you, some may not. Some of them you could have already addressed in your trading plan. But as you are all aware, the markets are constantly changing, and your plan is going to change over time. The journal, your review, will be the quickest and best way to track the changes in the market as it relates to your plan. Andre?
All right. Well, Big Mike, again, I want to say thank you. Thank you to the audience for giving me your time, lending me your ears, like I said in the beginning. This is a topic that I'm very passionate about, the review and self-improvement, where we are our own coach. Yes, we can seek out other help and other opportunities and read all the books out there that we can, but at the end of the day, like I mentioned earlier, it's about looking yourself in the mirror and being honest with yourself. You know, the self-review and evaluation process is definitely not the most glamorous part of this job, but what it does lead to is extremely glamorous, for lack of a better phrase, and it is worth it. I cannot stress that enough. It is worth it to do. You know, there's going to be times in our trading career when it's not going to be fun, and we're going to go through dry stretches, and it's going to be rough, and you may feel like you might need to step away. Future might be bleak, but, if you can slow things down, keep grinding, harp back on your data, see what the things that you've done well in the past, see what your strengths are, it will get you back to the fundamentals and it will get you back to basics. And the bottom line is you will get through it and you will succeed. Keep grinding and appreciate the process because it's worth it. There's no better job in the world out there than being futures traders. So I guess with that being said, I'll take some questions.
Thank you very much for having us again, Mike. We
Sure.
really appreciate it. And again, if everybody was able to just learn something or carry something away from this, then we've succeeded in what we were trying to do. So thanks again, Mike.
Sure.
Thank you.
Thanks, guys. So at this time, if anybody has questions, you can go ahead and type them in. Thay is asking, when will NinjaTrader be supported?
Without a definite, approximately 2 weeks.
Okay. Doug asks, he says it's currently in a combine. Each combine has a max contract number. How smart is it to trade the maximum amount of contracts while trying to do a combine and get funded?
I would say trading your maximum quantity allowed on every trade is not the best strategy.
Yeah.
I would say you have a default quantity, whether, say, you are a 15 max contract trader, I would say your default should be somewhere around 5, about a third of your max. Based on your confidence in that trade to be profitable, you then up your size. Like I talked about in the presentation, if you are on a hot streak, yeah, then you max out and you really start expanding your risk parameters. But I would say a third of your max quantity is probably where your default should be. We're not trying to hit home runs every trade. So keep it simple, keep it basic.
Okay. Let's see. Josh wants to know, is it acceptable for the MAE to be larger than the stop loss besides a tick or two for slippage? I'm not sure I understand that question because the MAE is always going to be the maximum amount that it went against you.
Right. I mean, if your max adverse excursion is greater than your stop loss, you're going to get stopped out.
Right. You had, something happened there, like slippage or something, I guess.
Mm-hmm. Yeah.
Okay, maybe he can reword the question. Let's see. Another question. Go ahead.
Yeah, I just have to correct something. From what I understand, it's probably about a month before Ninja's supported.
Okay. Thanks. Another question Josh is asking, when reviewing losses, how do you know which ones are legitimate? Some losses are inevitable. Which ones could have been addressed by a corrected plan? Lots of opportunities for self-deception. That's definitely very important, and that's where the honesty comes in, right?
Absolutely. No, it's to be able to distinguish, what was created by a faulty plan, or how you're going to be able to review to avoid that loss in the future is just part of the review. You're going to take a look at the trades that you've made from now moving forward. When you see that situation again, that's how you're going to know. But if you're not trading it consistently and honestly reviewing, it's going to be more difficult for you to realize that situation and avoid it in the future. But nothing is absolute. Anything can happen at any time. So you're not going to be able to absolutely be sure that next time you see that same outcome is going to occur. What you're trying to do is review your trading plan, review your trades, so that you can find ways to locate the best trade locations that offer the best reward for the risk you have to take.
Right.
If you're taking trades in places where the risk is too great, it's time to take a look at your trade location part of your plan.
One of the things that Andre had said earlier that I totally agree with is to try to record the information as soon as you can, because the more that time elapses, the more your mind is going to do its magic, and you'll start remembering things different than they really happened. And that was personally one of the things that was the most eye-opening for me, my own trading, is I went through a process for a while where I was videoing myself. I used Camtasia, and I would have my DOM up, and then I had a webcam, and it had the ability to do like a picture-in-picture. And man, talk about an eye-opening experience when you're reviewing it, because how you remember. You can you don't think that you're deceiving yourself, but how you remember something versus how it really happened when you're looking at a actual recording of the event can be a really eye-opening experience. So I think that if you're trying to figure out legitimate losses, for example, then that's definitely going to come back to how accurate the information is to begin with.
Yeah, that's why we created this trade ticket, so that you could have that right in front of you, as you're taking the trade, as you're watching the trade, really in real time. Just write down and record in hopefully an easy fashion what you're seeing and feeling during that time.
Right. Yeah, the whole video recording was definitely not easy. Let's see. I see several questions about this, so let's just clarify one more time. MAE, maximum adverse excursion, maximum favorable excursion. It's basically how much a trade goes against you or how much it goes with you before you exit the trade, just to make sure everyone's on the same page.
Yep.
Okay, let's see. Grammy's asking, regarding MAE and MFE after a trade, how long after do you suggest tracking that, as the longer you do, the more chance market state will change on news or et cetera?
You're talking about tracking market price action after liquidation of the trade? I would say, I'm out of the trade now. I'm already watching the market for another opportunity, so my eyes are there already. It's not something I'm going to say, well, the rest of the day the market rallied another 10 handles, and I'm going to say, well, then that was a bad trade. In your time frame, if you're in trades for generally 30 minutes to an hour and you get out of a trade at 45 minutes, keep an eye on it for the next few minutes.
Yeah.
I like to track the price action. Maybe I've misjudged market state a little bit. Maybe volatility could be increasing or decreasing. I think watching how it trades afterwards, just for a little while. You don't have to. We're not talking all day because you drive yourself crazy. But I like to watch and see. Okay, was that target nice and accurate? I'm a stickler for trade locations and for target locations. I don't take a lot of heat on trades. I trade in places that have previously been rejected or accepted, and I have pretty defined areas of failure. So if I get stopped out on something, I'm probably going to watch and see what happens with the trade. If it returns to that area where I was interested in taking the trade to begin with, I may consider taking a trade in that spot again.
Right.
But I'm not going to watch it for the next half hour and see what happened. I'm going to make a note on my trade ticket where I got out. Okay, price action continued in my direction for another 2 handles in the next 10 minutes, and I'm going to try and keep track of that because I think it is important for evaluating how well you're picking your trade locations and your profit targets.
Yeah. Sorry about the background noise. My puppy is throwing his bones around. Isn't that fun?
It happens.
One of the things that I do personally, I call it a benchmark, and it's not something that's realistic. It's just what is the absolute best possible tick count. I measure it in ticks that I would have got on this trade with a perfect entry and a perfect exit, and then that way it just kind of gives me something to compare against. What was my actual performance versus what was the absolute best. Now, it's not realistic. You're never going to get the best entry and the best exit, but at least, I have something to compare against.
You can see how big of a bite you're taking out of them.
Yeah,
right.
I like that. Just get a chunk out of that move.
Right. Okay. Let's see. Chris is asking. Oh, we've already covered NinjaTrader. You said about a month or so.
Yeah, that's really kind of out of our control. We're still working with the providers and everything. So.
Yeah, understood. Gary says you're talking about trading plans, but there are many types of trading plans, from an overall trading business plan to an individual strategy trade plan. Which one do you focus on?
I think it's important to have all of it. My trading plan begins with my account numbers, the telephone numbers, and it ends with me getting out of the last scenario that I have in my trading plan. It goes from just the basic details of my accounts, the phone numbers in case I have emergencies, in case I have questions, and then it begins. It starts with the tool usage, and then it goes into the specific situations that I'm looking for as it pertains to a ranging market, as it pertains to a transitional market, as it pertains to a trending market. It's a couple dozen pages long, and it gets rewritten about every 6 months because it's done in pencil and paper, and there are scratch outs and notes and additions, and every about 6 months I have to sit down and kind of recompress it and use the information that I've been saving as part of the plan. So it is a business plan because you are a business. You have to treat it that way. You have to have a business plan, how you're planning to build your business, how you're going to treat your risk, what your goals are as far as not necessarily monetary goals, but your personal goals. How are you building your mental capital? How are you doing with the mental side of trading over and above your metrics? One of my goals is to maintain a risk reward greater than 3 to 1. It's not that easy when the markets are not moving all that much, but it is something that causes me to focus on great trade location. I miss some trades because I get pretty stingy with where I'm willing to get in, but there's always another trade coming down the road, and even with the ranges that we've had in the ES, which have been, I think, considerably smaller than history, I'm still right around 3 to 1 in my risk reward. So that's all part of my business plan, and these are some of my goals that I'm trying to just stick to.
Yeah.
So the trading plan is a business plan as well as a plan on how you're going to look for, how you're going to identify, and how you're going to manage trades. And
so I see a lot more comments about NinjaTrader, and I just want to remind everybody that next Thursday, April the 4th, Michael is going to be back. He's the CEO of TopStep, and he'll be doing an Ask Me Anything session. So that'll be a more appropriate time to talk about that. Okay, next question. Gary also asks, he says, I've learned that risk management is job one and profit is job two. Portfolio risk is very different than individual trade risk and is based on many things. Do you really change your level of risk as the day goes on?
Well, as much as I try not to, and I try to treat every trade as independent to one another, you kind of do. As far as portfolio risk goes, I assume he's talking about your account balance. If I have a good Monday, Tuesday, and Wednesday, and I'm up a little bit of money going into Thursday and Friday, I will be a little bit more risk adverse going into Thursday, especially Friday. I look at my portfolio or my account. I look at it on managing on a week-to-week basis, more on the macro level, and then obviously the trade-to-trade basis on the micro level. As much as I try to be as objective and keep every trade independent of one another, sometimes it's hard. It's hard to not look at your daily P&L, and it's hard to not generally estimate what your overall account balance may look like. I've gotten better over the years with not doing it, but I'm not going to lie. If I have a nice 3 or 4 day stretch going into a Friday, I may make one trade or two trades on a Friday, and especially if those are two losers in a row, most likely I've done for the week because I'm not going to try to get those back. And I sure as heck am not going into Saturday with a losing week. So as far as risk management goes, yes, you manage each trade as best you can individually. But if you have a good week going into a Thursday and a Friday, slow it up, tighten up those stops. Make sure it's a good week. Don't lose it all on a Friday. I've been there a couple times, and Saturday and Sunday are terrible. So that's my best advice to that.
Yeah, I'm from the school of thought where as the day progresses, you should definitely be. I call it a daily trailing stop. If I'm up $500, I'm not willing to lose more than half of it.
Yep.
If I'm up 1,000, it may be 30% of it. If I'm up 2,000, it may be 20% of it. When we all started out trading in the pit or whatever, it was you saved your money, you opened an account, you leased a seat, you went into the pit, and you started trading one lots. As you figured out how to stop losing money and started to make a little bit of money, you worked on building your account. As your account built, you were able to increase your risk a little bit just by adding size to your plan. And I pretty much stuck to what size I was at in my plan. I never really got beyond the 10 lot area where there were people that were much more aggressive, that were trading 10s and 20s and 50s. I wasn't comfortable with that. It's important to know your limits, I guess, and as you're building the account, yes, you can add volume to your plan if it's working, but I tend to stick to that. I don't. If I'm up at noon, I don't gun it to try and hit a big winner. I stick to what I'm comfortable with, what I know, and where my account allows me to take the risk. If you are making money as a trader and you are adding risk as you're building your account, well, you're taking money out of your account probably as well. It's difficult to build an account that you're living out of. Once you get to a point, you're gonna have some sort of a baseline in your account, and hopefully you never go back down below that baseline. But that kind of tells me, okay, this is my risk, and this is what I'm comfortable with, and I see the market well trading this much risk, and that's pretty much what I'm going to stick to. So
that's good.
That's how I view that. If you're up, taking that big shot is one of the best ways to give it back, because I've done it. I mean, speaking from experience, I've taken all the risks. I've done all the things that I probably shouldn't have done, but I carry that with me now.
And okay, so regarding portfolio, I just want to make a quick mention that there's a really fantastic webinar that Ernie Chan did for us, and he talks about capital allocation and risk, which also includes portfolio management. So for those that are interested in that, highly recommend that webinar. All right. JJ asks the question, what is the percentage of successful traders in the combine that place orders from Sierra Chart? And again, we're getting off topic for this webinar, so I want to remind everybody that those types of general questions are probably better asked next week, Thursday, April 4th, when Michael is here. But do you guys have an answer?
You know that, John?
I don't know Absolutely, but it's a smaller percentage. We don't have that many people that are
I don't
using
see
it.
it very much. No,
Right.
I don't know. I can't tell you.
Okay. Another question from Gary, and just so everybody knows, we're currently asking questions from about 15 minutes ago. Let's see. Gary asks, what do you think of automated trading to control risk and profit management?
I'm fine with it. It's not something that I've chosen to get involved with. If you can put together something that's going to work, wonderful. I've found that the people that I know that are doing that, they have success for a period, and then it just doesn't work out. They have to go back to the drawing board, start over. So they're constantly in development because markets change way faster than those programs can be changed. That's why I think a discretionary trader that has a viable plan and the discipline to stick to it is probably going to be able to outlast any particular ATS plan. So in my experience, yeah, it's a great idea. It's a great concept. Just have your trading plan executed automatically with no emotions, no nothing. But I haven't seen that many individuals that have been able to create a plan that's been successful for a longer period of time. You got your companies that have MIT guys constantly coming up with these plans, and they work for a while and then they're done.
Right. Let's see. I'm skipping questions that are really not at all related to this webinar, and I think that those are more appropriate for the open Ask Me Anything next week.
Okay.
So I'm trying to look for just ones that are kind of on topic here. Rain wants to know, how can you translate the win-loss ratio into your trading edge?
The win-loss ratio. We're talking.
I don't know if he's talking about win percentage or if he's talking about dollars risked.
Risk reward or win-loss.
The profit factor takes into account all those, I would say.
Yeah, if we're talking about risk reward, you got to take a look at how often you're right and how often you're wrong. And that's somewhat skewed. I think for a very short time frame trader, it's a lot easier to sustain a high win percentage. But they're going to be cutting profits. They're going to be in for a few ticks, and if they are risking 10 ticks to make 2, and that win percentage falls off, if they're counting on being right 80% of the time, and it falls to 60, well, then they're going to have a problem. They're not going to be able to cover their losses with that many wins. So. And I believe that to maintain a high win percentage is very difficult and energy draining. So my idea for traders and for anybody that's taking risk on anything is to make sure that that if the trade plays out, you put the trade on, you put a stop in, you put a profit target. The profit target needs to consistently be greater than the stop loss. If you can have a 2-to-1 risk-reward ratio and maintain that and be right half the time, you're going to at least cover costs. You're going to be what most trading psychologists would call a competent trader. You're going to be accomplishing something that 90% of people that do this could never do. So, when it comes to win-loss ratios or risk-reward, take a look at that profit factor. It will tell you, what you need to shoot for at any win percentage as far as how much you're going to have your risk reward leaning your way. I think that anybody can do this if they just take the right steps, do the right things, learn the right things, and they're disciplined and they take the time to develop themselves as a trader, but it's so important just to keep the math on your side, and that's just the way I explain it. Is it's a mathematical equation. If you can reach that equation in your actions and in your trading, you're going to at least survive, and hopefully you're going to keep learning, keep building mental capital, keep building an account, adding volume, and be able to increase your profitability within that plan indefinitely.
Yeah. don't make the mistake that I see too many traders, newer traders especially, make, where they'll see somebody say, oh, I have an 80% win rate, and then that doesn't tell you anything. Just saying 80%, that means nothing. You can have a 99% win rate and lose extraordinary amounts of money.
Absolutely.
So you guys got to focus on the whole picture. Let's see. John is asking, does Top Step keep track of positive and negative trades so that he can find the personal best time for him to trade? So do you track it based on hours of the day or anything like that?
No, our trade reports don't track it by hours or anything like that. We do track metrics, as far as the entire day is concerned, what your win percentage was for the day and overall risk reward for the day and overall trade durations for the day and overall for each combine, as well as many other metrics. But no, we're not. It doesn't track your times on your trades and which time would be best for you. That would be something that you might want to visit our website and go to contact us and get this trade ticket and get the reconciliation for it, because it has times on it. You put your times for your trades down, you're going to be able to track that over time in your journal, and it's going to give you the information that you're looking for.
Right. And John, just so you know, there's a journaling software out there that's pretty popular on BMT. It's called TraderVue, VUE, and he does all that. And I know it works with T4, also with Sierra. You can export, and it'll give you all those kinds of statistics.
Right, it gives you all that information. Yeah, I know that there are some really good programs that'll do all that for you, but I just can't get away from my pencil and paper. It's just the way I've been doing it for so long.
Let's see what else we have here. Frank wants to know, he says, speaking of opportunity time, on order entry, how much time should one allow a trade to fluctuate before you decide to exit?
Well, it's a good question. When you're doing that, when you're in your trade, you got to know what kind of market state you're in. If it's a range-bound trade and you're not getting to the extremes or the upper bound and lower bound of that range, and it's just sitting in the middle, what I'm doing is I'm looking around at other markets. I trade three different products. So say I'm in the S&Ps and it's a range-bound market and it's just sitting in the middle. We're in like a 4-handle range and we're chopping around for one handle to 2 handles, and we're not really touching the ranges. I'm looking at other markets. For instance, today the euro currency was really rocking and rolling today from all the stuff coming out of Europe, whereas the S&Ps were kind of grinding higher, looked like a range-bound trade, was kind of a grind. If I see another market's moving that I do trade, and I do trade actively, I'm getting out of that market that isn't going according to plan. I'll just get out of it, whether it's a small winner or a small loser, regardless of profit target or full stop out, and I will look to actively observe and come up with a game plan and get into the market that is moving. You kind of, the more and more you do it, the better feel you get for it, and the more you know that maybe my attention is better spent elsewhere. Basically, like with all opportunity costs, where can I make money quicker, and where is there more of a better, I guess, more action? So I guess what I'm looking for. I'm looking for the volatility, and if that market isn't moving, and there is a market that I am trading that is moving, I'm more or less likely to get out of the stale market and get into the market that there is decent opportunity. So I encourage you, when you are in the market, I encourage you to look around. Don't don't put the blinders on and just stay zoned in on that market that you are in. There's a lot of going on all around you that you may or may not realize.
And I think it's important to take a look at your trading time frame too. If you're a guy who averages 5 minutes in a trade, you've been in that trade for 4 minutes, it hasn't gone anywhere.
Yeah, it's time.
That's a good point. Okay, so just so everyone knows, we're currently answering questions that were posted 25 minutes ago. Let's see. Dennis asks, if you close a winner early due to market-generated info or you tighten the stop, that changes your risk reward for the trade. How do you account for this dynamic in your review?
Yes, it does, and it's a really great question. That is something that on my trade ticket, that would be a managed stop. I don't move profit targets for that reason. provided there is a profit target. I may, in a trending market, I may not have a profit target. I may look at that and say, you know what, I'm either going to get stopped out trailing this stop, or I'm going to getting out MOC on this trade. So if I'm going to be getting out because of market-generated information before it reaches profit target, it's going to be called a managed stop exit, and that is another part of my review. Because when I have stop out, and it'll say full or managed, so that will go into a different part of my review. If there was a valid reason, a news event came out or something, and my managed stop got hit, then that's a good thing.
Yeah.
But if you're constantly moving profit targets or getting out of trades because you're nervous that it's going to turn around and go away from you or whatever, then that's one thing. But if you're accounting for in your plan those things that are going to happen, unforeseen, and you're right, they will tend to skew your risk reward. But even with my risk reward at 3-to-1, I do have a managed stop out once in a while. Sometimes it's a mistake. I've moved my stop too close. I put that managed stop there. I make my note. I move that stop a little bit too close for the market state, and it's something that I will review later on in the day. I'll take a look at that trade ticket. I close my eyes and actually put myself back in that place and think about what I missed, how I may have been able to bring forth a better outcome for that trade. But it goes into kind of a separate statistic. So a full stop out and a full profit target are one statistic, but I don't separate them as far as my risk reward is concerned.
Right.
But I do look at the trades a little bit differently.
Okay. Jim is asking. Okay, I want to make sure we got. Okay, yeah. Jim is asking, do you keep a list of commodities that suit different personality types? Is that something that you can help other traders assess, or is it solely up to the trader's own discovery? Have you helped anyone? Sorry, the last part of his question is: have you helped anyone find a commodity to trade that better fits his or her personality?
Yeah. Oh, yeah. Yes, we have on a number of occasions, and what seems to fit certain traders at certain times changes over time. So, but we've had a number of people come to us and say, I don't think I'm trading the right market. We talk to them, what kind of personality do you have? We get a little bit into who they are as a person, and sometimes we're able to bring them to a market that seems to fit who they are as a person a little bit better. Somebody that needs to be involved all the time, I think, is better off in a more volatile market. It's going to be exciting for them. Somebody who's a little bit more reserved and perhaps calculating. That's a whole nother situation. They may not like the volatility. They may like to have the time in order to research their trade a little bit longer, and a high volatility market's not going to offer them that. They'd end up chasing that market around all the time. So yes, we do. We have talked to a number of people about, I don't like what I'm trading. I think I should move to something. What do you think I should move to? Talking to one guy maybe as recently as about a month ago, that was trading euro, and he just didn't seem to be getting it, and he decided through a conversation we were having he was going to try the NASDAQ, and he's been ecstatic with his decision. It just seems to fit him better. He sees it better, and he's been enjoying better success with it. So largely it is up to somebody to kind of look at who they are, and it is something that we have helped people with, though.
Okay. Merritt asks, he says, John, have you, or how are you specifically compiling the MAE and MFE data and using it to provide you with pertinent information per your own trading? What format do you use to compile the data into? Is it some type of a chart? What does it look like?
Well, at the end of the week, I go through my trades and I'll average my MFE and MAE numbers for for all the trades during the week. Okay. Then at the end of the month, I do it again. If I'm finding that those numbers are increasing, I'm getting more excursion to either or both sides. That's telling me that I'm probably dealing with a market that's increasing in volatility, and I need to take a look at my trade locations and perhaps increase my my profit targets. So I don't like to increase my stop levels. I like to trade close to the areas of failure, close to areas of rejection, like I said before. So I'm usually pretty steady with my stop prices. Not that I want them static, but I'm very picky with my trade locations. But if I'm seeing the if I'm seeing the excursion numbers increasing, that's giving me an indication that I saw a more volatile day or week or month, and I'm going to be looking for signs of that to continue or fall off. So that's, I mean, really how I do it. It's really just to decide how reasonable my expectations are as far as profit targets and how stingy I can or need to be in my trade locations.
Right.
If that makes sense.
Sure. And both Neo and Joe are asking a similar question. They're asking, how can you calculate scale in and scale out trades in a metric? Are you using or are you considering them as independent trades or part of one trade? Do you obtain the 3-to-1 by scaling out, or is it all in or all out?
Most of the trades I take are in ranging markets. I'm not, admittedly, a good trend trader. When markets are ranging, that's when I tend to do my best trading, and I'm all in, all out. I find it difficult to add to trades quick enough in a ranging market to make it worthwhile. So I'm very, very rarely scaling out of anything. If I do happen to catch a trend with multiples, it's probably going to be. I'm going to look for some pretty extreme pushes in the direction of the trade, and that's where I'm going to take one off. As far as maintaining a 3-to-1 risk reward with multiples, it's going to be more difficult. People who do, with different targets. If you put a 3-lot on and your stop is 10 ticks away, I'm of the opinion that your first exit needs to be 10 ticks away. Okay, so now you've made 10 ticks on 3. Now you're probably going to manage your stop from that point to take the risk off the other 2. But if you come back with the other 2, if the market comes back and stops you out, now you've really skewed your risk reward because you had 3 on, you profited 1-to-1 on one of them, but you scratched the other 2. If that trade had gone the other way, you're looking at a full stop out with 3 contracts. So when people talk to me about scaling out, I try and caution them about that. There are people that I've talked to that believe that that's one of the many roads to ruin in futures trading. If you are scaling out in the wrong market state, you may end up with problems. If you are in multiples in a trend and you are getting out as that trend continues, I would say, well, number one, if you're in that trend early, you should probably be adding to that trade and trying to manage a stop at a real reversal in that trend should something happen. But you can have some hugely profitable days in trending markets, and I've had a couple. I'm not that great at them, but I'm really kind of nervous about people that like that scale out
Okay.
trading.
Okay. I scale out, by the way.
No, that's fine, but I'm sure that you've got it in your plan that you're going to be scaling out and making sure that you've got a good risk reward ratio on all 3.
Yeah, no,
or on each multiple.
Yeah, I agree with everything you said, and I just want to quickly mention that there's another guy that did a webinar. If you go to the webinar section and do a search for trade management by FT71, he did a very statistical overview of all in, all out versus scaling in, all out. Or I'm sorry, all in, scaling out. So comparing those two, and it might be of interest to anybody that wants to take a look. Okay, only a couple more questions here, and then we'll wrap things. Michael is asking, is there any good business plan example out there that you can cite?
It's kind of an individual thing. I don't know that there's necessarily a template. There's guidelines out there as far what a business plan should look like. We do have examples that the coaches, I know at Top Step Trader, some of the coaches, if you were to get in contact with them, we can put you in the right direction that way. It's a very individual thing. We do have a basic, when we take a trader live, it is required that they do fill out a trading plan, and we do have basic guidelines and setups that they must take into account. So if they want to go that route, we can show them that way. Mine's different from John's and well aware of that, and the CEO, Michael, here at Top Step Trader, I'm sure his is different than both of ours. So if you contact some of the coaches at Top Step Trader, we could definitely show you some, I don't want to say generic, but I guess somewhat of templates, but it's a very individual thing based on your personality, based on your hours of availability, your times you will be in the market.
I think it needs to be personalized so that you can really own it.
Absolutely.
It has to be yours.
Yeah. Sure. I agree.
Let's see. Steve asks, by quitting early, are you saying that your edge is no good and you're gambling? Why would you quit if you have a good edge?
Well, your edge is only as good as the market will allow. That's a good question. If my edge is, I'm able to read correlating markets well, there's my edge. I can see markets. My indicators are watching leaders and laggers. Well, if my leaders and my laggers happen to be backwards for that day, yeah, for that day my edge is gone. Yeah, it can very well be true. For that week, my edge could be gone. I'm quitting just to live to fight another day. I'm not going to blow out all in one day because I'm stubborn and stuck in my ways that, my edge is here. I can't. How can I be wrong? How can the market allow me to be wrong? My edge is my edge, and
yep.
To hell with anything else. It's very adaptive. There's no one set rule.
Let me ask you my own question that often comes up.
Sure.
For this type of discussion is, do you trade to a profit target and quit? There's been a lot of discussion over this, obviously, since the first days of trading was born. Sure. Hundreds of years ago. So, some people are of the mindset, if I can talk, that having that goal is good for all the psychological reasons, But then there are others that say mathematically you shouldn't have a target because you're just limiting your gains. So what do you think?
I have my hours that I trade from the day. I'm usually putting in between 9 and 10 hours a day. Extenuating circumstances obviously come into play. I don't have a number by any means. I'm not shooting for a certain number that I'm trying to reach. I'll trade from 5:30 in the morning Chicago time to the close about 3:30, 4 o'clock Chicago time. And I trade as I trade. I follow my process. I follow my plan, and I stick to it. Now, if I have multiple consecutive losers in a row, then I'll stop the day early.
Yep.
But I just trade the hours, and I guess you kind of let the chips fall as they may based on my preparation that I have on a Sunday and my plan execution and my reading of the markets. But I don't trade. I don't trade to a number. I trade to my my preparation and my strategies and my tactics and eventually my execution. And once I'm in the market's going to do as it pleases. All I can control is my intuition going into it. Once that happens, the market's going to do what it's going to do. So no, I do not trade to a number. You can, if I don't know, I guess if you're trying to buy a certain car or something, you can trade to a number. But
I think that it's better to I think that you can trade to a X, and X can be defined in many different ways, but probably not using a dollar amount is the way to go. Because if you measure it based on how good you're trading, which isn't necessarily how much money you're making.
Exactly.
That's probably a better way to.
I would wholeheartedly agree with that. There is no set number. Some of my best trading days, I end up making maybe $800, $900. I followed my plan accordingly, but the market wasn't giving as it normally would have based on these parameters and these things that I've seen. So you can all you can control is what you can control. The market's going to take care of the rest.
Okay.
Mike, there were two schools of thought in the pit with that. There were the guys that stood toe-to-toe with the market from 8:30 to 3:15,
right.
no matter how much they were up or down.
Right.
And then there were guys that said, I'm in here to make my $500,000 and I'm going to go play golf.
Right.
The ones that stood toe-to-toe that were really good traders ended up with really, really successful careers.
Yeah.
Then there were the guys that wouldn't leave the pit. If they were down money, up money, they gave great days back. Right. They brought back horrible days. but I don't think they withstood the same longevity.
Yeah.
And then there were guys, like I said, that they came in to make their $500,000 and they would leave, and they were really good at doing that, and many of them went on and bought multiple seats, and we all know how that went. So
Yeah.
these were some smart guys, and everybody has their own thing.
Right.
One of the best traders I ever knew wouldn't leave the pit to go to the bathroom. He was in there from bell to bell, no matter how the day was going. That was it.
I think I think you hit the nail on the head. There's not a best answer. It's a personal trait. It depends on your personality more than anything else. So,
and it may seem like we're taking the easy road on some of these answers, but it's the truth.
yeah,
It's
there's not
so
a lot
personal.
Yeah, with trading, there's not a whole lot of black and white. There's lots of gray. Let's see.
And most of it's in my hair.
John asks, can you comment on entering a trade with multiple contracts with one close target to produce a free trade, and then the second half, to produce a free trade for the second half of the position? I know it's twice the risk at the start, but it makes it easier to hold a position for larger profits. So basically, I've heard this free trade concept, many times, and it's kind of what we just talked about on scaling out. So what do you think?
Right. You better have some pretty good trade locations. That's just my thought. The free trade thing is great, but again, if you put it in there and it runs for a full stop out, if you're going to take half off for a quick profit for a free trade, you're going to move your stop up, and God, I don't know how many times I've heard, every time I move my stop up, the market hits it.
Yeah.
So you've got to be careful with how quickly you're going to move your stop up, and then you're going to have to, if you've got 6 contracts with 10 ticks risk, that's 60 ticks. If you take 3 off at 5 ticks, you've made 15 ticks. You've still got 45 ticks of risk, so that last 3 lot's going to have to go big time your way for you to cover the risk on that trade.
I know several really good traders that do kind of subscribe to this free trade thing, but I personally cannot wrap my head around it. To me, it's too similar to moving your stop to break even. That makes no sense to me. The market, what did the market do that told you that that's a good decision? Move your stop to break even. That's the way I personally operate.
I agree. You trade to prices. You're not trading based on your fundamentals. I agree with that.
Yeah. So anyway, I guess it's one of those things that's very personal for everybody, right? Okay. Let's make this the last question here. Merritt asks if he has an average win-to-loss ratio that consistently ranges between 1 and 2.5 over the past year. Is his sample size too small? Should it look for more? I'm not understanding the second part of the question. He says he's using a rolling 20-trade average. I don't know if it. I don't know.
I think it's just the average of his last 20 trades.
A rolling average, yeah. I don't know if really the year or the months has anything to do with it. It's more the number of trades, right? If you're asking if the sample size is too small, what do you think is a number that's a good number of trades?
20 trades. Well, it depends how frequent of a trader you are. If you're only making 4 or 5 trades a day, 20 trades is going to give you about a week's worth of data. You probably need some more. I suppose I would say for what's been going on, just being current with it. Come Friday, I would probably look at a 2-week span based on just how the trade has changed with a lot of focus on what's going on in Europe. So there's your sample size right there. I'd give it 2 weeks worth of data. 20 trades, maybe you want to expand a little bit more, but it's kind of a time-sensitive issue, I would say. Whereas in end of December, everyone was worried about the fiscal crisis, or then we had the fiscal cliff situation, and those markets all changed. So I would kind of maybe mark on the calendar, okay, the big focus was this for this week or this for this month, and kind of extract the data based on what is going on currently and keep it time sensitive and current as always. But 20 trades, I don't know your frequency of how much of a trader you are. You might want to expand it a little bit more just so you get a little bit clearer picture.
Yeah, I think he's a scalper. I think some of the mathematicians.
I'm a scalper too, so you're going to want some more data than that.
From what I've heard from the mathematicians, I think that 30 is the magic number to be statistically relevant. But man,
There you go.
that wouldn't work for me. I got to have like at least 100.
Yeah, I'm edging closer to that number too, Mike.
But again, I guess it's personal. I know that Merritt is I know who this guy is, and he's a whiz at Excel. So I'm sure that he's got everything he needs right in front of him. All right, so let's make that the last question. So anybody that did not get their question answered, how can they contact you guys?
Come contact us at, again, topsteptrader.com/contact us, and we'll take on all and any questions. And if you want that trade ticket or your journal entry template with the reconciliation page, hit us up at topsteptrader.com/contact us. I use it. John uses it. We've got a lot of our recruits and trainees and live guys. They're all using it. We're seeing results. We're seeing success. And it's actually worked out really nice. So we're kind of happy of what we've seen come from it.
Yeah, I like the look of it. It's fashioned after a trading floor order ticket, so it feels very comfortable for me to use. And you can develop your own system for using it. Use it however you want, and hopefully it will help.
Right. Well, thank you very much, John. Thank you very much, Andre. And I really appreciate your guys coming today and spending all the time and preparing the presentation, answering all the questions as always. And for everybody else, I want to mention one more time that next Thursday, April 4th at 12 noon Eastern, the CEO of TopStep will be here to answer your questions. So that would be a better time to ask some of these more open-ended questions that weren't really on topic for today's webinar. So tune in again next Thursday for that. All right, guys, I'll post the recording of this webinar on BMT sometime tomorrow. I will also send it to TopStep Trader as always, and they can direct you to it if you ask them. Thanks, guys.
Thank you.
Thank you, Big Mike.
Bye.